All right, so let's talk about paying off your loan. And we talk about a home loan is usually for a longer tenure. It's very important for one to decide a repayment strategy before taking any type of loan. At the same time, just because you are paying off loan and making one asset for yourself, especially if it's a home loan on you, it's very important to keep continuing your investments. But how can those investments help you repay your existing financial liability, even in the form of home loan, which is supposed to be a good loan? Let's elaborate more on this. I have with me Varun Fatehpuria, founder and CEO of Wealth Management. Varun, hi, good evening, and welcome to the Money Show. Varun, a lot of time we keep getting questions from our viewers where they want to have a strategy where they can also keep paying the EMI, but also at the same time want to pay off their loan, and especially home loan, before the entire tenure. Do you think this is more of a cash crunch situation if one tries to pay off the EMI and also have an SIP maybe in mutual fund at the same time? Is it too much of financial pressure, or it is the right kind of strategy that one should be adopting, especially if you want to get rid of that home loan?
Hi, Kavita. Good evening. Thank you for having me on your show today, and I look forward to speaking to the viewers and listeners of ET Now. As you correctly pointed out, home loan obviously is a big burden. It is a longer tenure loan that most of the homeowners today are taking, and it can basically cause a substantial monthly burden throughout the tenure of the loan. But at the same time, most of wealth advisors like us typically advise our clients not to stop your SIPs, but to have a perfect ratio between what is the percentage of your monthly income that you are servicing towards your EMI and what is the percentage of income that is going towards a SIP. As a good rule of thumb, you should try and keep your EMIs anywhere between 25-30% of your salary, and the remaining 20% of your income should go towards creating a wealth corpus, whether you're doing it directly or through MFs via SIP. So we'll have to keep those things in mind. And if you allow me, we could go through a quick example with respect to how one could pay off their home loan by also simply simultaneously investing small sums of money into mutual funds via an SIP.
So, Varun, just to explore the kind of investment instruments one can use, are we specifically talking about mutual funds, or you think that's the best way to accumulate the loan repayment amount that you are looking at?
So, Kavita, I think broadly, when you're talking about longer tenure wealth creation opportunities, you're looking at growth assets, right? And typically today in a country like India, the most favored growth asset is equity investing. If you have the time, knowledge, and resources to do that equity investing directly by yourself and individually select your stocks, you're most welcome to do that. But most of the investors typically do not have the bandwidth and the knowledge to do it, and that is why mutual funds as a vehicle is a very efficient, disciplined, and just a simple way of investing into equity as an asset class. So if you don't possess that kind of a knowledge, then always stick to investing into mutual funds through a reputed and a professional fund manager. These asset classes, these instruments and vehicles tend to be a lot more regulated compared to doing things directly by yourself, where you may or may not be able to reach your goal on time.
But the first choice, if you are someone who understands the market, should be direct stocks to accumulate that kind of a fund for yourself, right?
So obviously, I think again, I mean, I wouldn't categorize that as a black and a white answer. I think that more depends on the behavioral instinct of the individual investor.
All right. So I can see you have given us a few calculations where you have assumed a loan amount and the kind of repayment strategy one can have by doing an SIP of a similar amount as well. So what are the examples, and could you please explain us the maths?
So sure, Kavita. So we are taking here a simple example of a 75 lakh rupees home loan that the home buyer has taken for a tenure of 20 years at 8.5% rate of interest. Doing simple calculations, we can see that he or she will need to incur a 65,000 rupees of EMI every month for the next 240 months to be able to repay that 75 lakh rupees of home loan that he has taken. What he also needs to keep in mind is that the longer the tenure of the home loan, higher is the interest component. So over a 20-year period, he or she in effect is paying about 80 lakh rupees in total as interest, with the total sum payable of approximately 1.55 CR, right? So obviously, longer the tenor of the loan, higher is the interest component, but lower is the EMI component as well. So let's unwrap that a bit better and methodically arrive on an SIP amount that he or she would ideally need to park every month to be able to foreclose that loan earlier than the intended schedule. So let's say if he or she requires to repay that loan in the next 5 years, what is the SIP amount that he or she would need to park every month to get to that goal? As viewers would know, every EMI payment that you make towards your home loan entails two distinct components, the principal payment and the interest payment. In the earlier years, if you do a simple repayment schedule, you will see that the majority of your EMI actually goes in servicing the interest, and only a small portion is actually going towards clearing of your principal. So, doing simple calculations, we can see that, let's say hypothetically, he or she needs to clear off this loan at the end of 5 years after having repaid approximately 9 odd lakh rupees in principal repayment. And these are calculations that you'll be able to find online by simply typing out that home loan amount, the tenure, and the rate of interest. So let's say he wants to clear off that home loan amount in the next 5 years. By the end of the fifth year, he would have repaid only 9 lakh rupees in principal, and he would be left with approximately 66 lakh rupees in an outstanding principal repayment that he needs to get to. So let's keep that as the goal amount. Let's keep that as an amount that the investor needs to reach to in the next 5 years, which is 66 lakh rupees. To be able to get to 66 lakh rupees, the investor needs to invest 80,000 rupees a month at an assumed 12% rate of return over and above what he or she is already paying towards their EMI. So obviously, it is a substantial amount that he would need to incur on top of the existing burden that the investor already has by paying off their monthly EMIs. But what if we are able to stretch this and go from 5 years to 8 years? If we simply pay our EMIs for another 3 years, we will see that the outstanding principal reduces from approximately 66 lakh rupees to 58 lakh rupees. Now, this becomes our goal amount. What is the amount that would be required to get to 58 lakh rupees in the next 8 years? And that comes to about 36,000 rupees. He or she needs to invest 36,000 rupees every month for the next 8 years at 12% rate of interest to accumulate close to 58 lakh rupees, which would be equivalent to the outstanding principal that he or she has at that point in time. Stretching this to 10 and 15 years, the outstanding principal reduces to 52 lakh rupees and 31 lakh rupees simultaneously. And the SIP amount also decreases to just 22,000 rupees and 6,000 rupees respectively. So as you can see, longer the tenor of your investment, lower is the SIP amount that you will need to partake every month, and longer is the wealth creation opportunity over there. So this is how investors, I would say, would like to actually think about in a more methodical manner as to when would they like to actually repay their home loan, how fast will they be able to do it, and what is the amount that they need to set aside every month to get to that goal.
And I'm assuming that you are also looking at a pure equity-oriented portfolio for this particular goal. And if you're talking about equity, there has to be volatility. So what kind of market cap investment are you looking at? How much do you have in mid cap, small cap? What should be the portfolio allocation? Because, when it comes to equity, it's definitely going to be volatile and you don't want to risk this money because it's going to go ahead and repay your home loan for yourself. So how can you also have a constituent, maybe some fixed income investment also, where you have a balanced approach and a bit of aggressive strategy that can help you accumulate this corpus?
So that's a really good question, Kavita, right? And that's the reason why in my initial calculation, I had taken at least a minimum period of 5 years. Anyone who's investing into equity as an asset class needs to have a minimum time horizon of 5 years to be able to see the totality of the returns. Had he or she wanted to pay off the home loans in let's say a shorter period of time, which is not really very achievable, obviously the asset allocation would have tilted significantly towards a fixed income or a debt allocation. But if he or she is borrowing money at about 8.5%, he will not be able to make that yield to compensate for that. So that is the reason why we have taken a longer time horizon. So let's stick with that example. Let's take that if we have a time horizon of just 5 years, ideally he or she should be looking at an equity allocation of 70 to 75%. And even within equities, stick to predominantly large flexi cap or value cap funds which have a more large cap bias, because again, mid or small cap can come with extended periods of underperformance, or if the investor gets caught in the wrong cycle, then the returns could in fact stay even flat in those funds. So that is why we have recommended that the investors put about 70-75% of their money into equities for a 5-year time horizon, and even within equities stick to large and flexi. And for the remaining 25-30% of the allocation, they could look at a more balanced approach. So something like a dynamic asset allocation fund, or which is commonly known as a balanced advantage fund, or a multi-asset allocation fund, where the downside is protected. The fund manager has taken hedged exposure to equity, and at the same time, investing into more stable asset classes like debt and gold, which provides that buffer and cushion to their portfolio. So if you look at the past returns, then over a sufficiently longer period of time, let's say even a 5-year horizon, the investors would be able to significantly compound their wealth at a rate of return which is higher than their cost of borrowing of 8 to 8.5%. So, in a 5-year horizon, we would recommend a 70-75% allocation to equities. But let's say if you move down a ladder a bit more, Kavita, if you're looking at an 8 or a 10-year horizon, then investors there could be a lot more aggressive. They could look at about 100% of their monthly allocation to equity. And within equity, they could look at about 45-50% to large or flexi, 15 to 20% to mid cap, 10 to 15% to small cap, and the remaining 5 to 7.5% to international equities. So by bucketing your goal and creating distinct, let's say, portfolios for a 5-year, 8-year, or a 10-year period, you'll be able to strategize your investment significantly better.
And within that, we should be having the best performance as a category in terms of
Which
fund
performance, sorry?
selection. So when you talk about having a specific market cap in a specific ratio, we also pick up the best performing funds in those categories?
So again, I think Kavita, best performing funds is something that rotates, right? I think winners rotate every year. What I would say investors should rather look at is the consistency of the performance. So rather than just chasing the best performing fund in any given calendar year or a financial year, rather look at funds which gives you a consistent performance over a time period of time. So let's say maybe a specific fund could not be a best performer for multiple years, but if the fund is able to give you a consistent return of 13%, 14% CAGR over a 5-year period, then I think that would help you realize your goal faster, right? We have already assumed a very conservative rate of return of 12% over there, and we have not gone very aggressive with our assumptions. So rather look at funds which could, number one, give you consistent performance, and number two, which are able to control the downside in case of a bear market.
Right. I think that will be all for today, and thank you so much, Varun, for being on the show and helping our viewers figure out how can they balance out their EMI and investments specifically to pay off their home loans. Thank you so much for being on the show today.
Thank you, Kavita.
All right, on that note, let's take a quick break, and post that we'll be having our viewers live on the show, and we'll do their live financial planning with Pankaj Matpal after this break.
If you like this video, then like, share and subscribe to ET Now.